Hello, everyone. Clint Lee here, research analyst for the Bauman Letter, along with Ted Bauman, editor of the Bauman Letter. And we have the next edition of Your Money Matters. And I know we've got a lot to talk about this week. So it's Friday as we're recording this. The Dow's lost about 4,000 points just this week alone. Something I read earlier today suggested that this is something like the 15th worst week in the history of the Dow. It's certainly been the worst week since the financial crisis, but to me, it feels like things are getting a little overdone now. The Dow's reaction during the financial crisis, I get that. We were on the verge of collapse in the banking system, but with this reaction to the coronavirus, because this isn't the first time we've seen an epidemic or a pandemic like this, and we had H1N1 back in 2009, we had SARS before that, and did not see this type of reaction. And even still, it looks like things in China are starting to get a little better. So Ted, maybe you can help shed some light on why the market has been responding the way it has to this episode of the coronavirus.
Well, thanks, Clint. There are all kinds of reasons, but the most important one is that the market had got pretty significantly far ahead of itself before this thing started. I mean, everybody knew that valuations were high, that the market was extended. People were nervous already. We saw institutional buyers moving into cash and bonds. We've had a bull market in bonds at the same time as we've had one in stocks, which tells us that a lot of money was sitting on the sidelines. So I think really in some ways the coronavirus is a catalyst rather than a cause. However, having said that, we know that the disruption to the global economy is very real. And the question mark is how long it will last, where it will be felt, and what kinds of companies will be impacted by it. Some companies we know. I mean, companies that make anything to do with the automotive industry are taking a terrible beating because their whole supply chains have collapsed. Airlines, energy companies, all that sort of stuff, that all makes sense. But there's a bigger group of companies that are down simply because everything's down. And remember, a lot of trading these days is in ETFs. It's in passive index funds. So when people sell, they're selling not just the companies that are down, they're selling companies that have no reason to be down. And so that brings everybody down. But the overall message, I think, is that we were due for a correction. This is the catalyst. The speed of it, I think, has to do also with the fact that this is an unknown factor. And the one thing markets don't like is the unknown. They don't like doing things that where they don't have clarity. And with the coronavirus, even though we have seen pandemics before, this is not something that we've dealt with on this scale in this type of modern globalized economy. So people are just saying, look, I'd rather be out of the market than in it for the sake of not knowing what's going to happen next. So all that stuff has led to this week's action.
So you talked about how this is just sort of the catalyst otherwise in a market that had just become maybe a little too extended. And I bring that up because I know here within the next week or so, we're going to start to hear all the chatter around this being the 11th anniversary of the bull market that started back in March of 2009. Since that time, I think we're up north of 300% on the S&P, even with this pullback. We're still even sitting on nice gains after the last more significant correction we had, which was late in 2018. We're still up somewhere around 20, 21, 22% since that time. But have we gotten too extended with those levels? And even with this pullback, do you think this is the right time to be raising cash? Is there still an opportunity to raise cash? Do we have bigger declines ahead of us?
Well, of course, there's no way to know whether we do have bigger declines ahead of us. I think for some sectors, yes. But I think the critical thing is that, that's the nature of speculative markets. We have been in the speculative market. Speculation, by definition, means that you're waiting to see what's going to happen. You're hoping and that stock prices are going to keep going up so that you can capture the price when they do. The problem with the speculative market is eventually the music stops and if you're playing musical chairs, you might not find one. And I think, in this case, this is really what's happened is that this is part and parcel of a bull market. When you have a bull market that is driven by a speculative desire to try to, capture momentum, then eventually when there's a turnaround, it's going to happen fast and it's going to happen quickly. And you just have to say to yourself, well, we had a really good run. We're up 30% since 2018. Yes, we're down now, but at least we made some money. Now, I think there are some cases where you might want to sell and raise cash, but in general, if you're in it for the long term, absolutely don't do that. I wouldn't sell any positions that I bought because I thought the company had a great 5 to 10 year future ahead of it. I would just let them ride and let them come back when the time comes. If I felt like I wanted to generate some cash to grab stocks that start rising again when the market turns, in other words, I wanted to have a ready reserve, then yeah, I might look at some of my positions and say, well, I'm only down 2 or 3% on this. Let me sell it. Then I've got some money to buy stocks when they turn around again. Then, of course, there's the question of people who need to sell equities because they, that's their retirement income. I know a lot of people have RMDs, but remember, required minimum distributions from your retirement accounts are annual things. So that, for me, wouldn't be the driver of selling right now. I wouldn't, be tempted to sell because I need cash for my retirement. I would rather just use a credit card and wait to see where the market goes back up again, and then I'd sell stocks to meet my RMDs. It's too early, I think, to do that kind of stuff. Overall, I think the message is it depends. I think having a reserve of cash to ride the market back up is a good thing, and that would be the only reason I'd sell at this point.
I think another important point to bring up too is, when we think about reducing our risk to the overall market, naturally we start thinking about just selling out of the positions that we already own, or at least trimming back maybe the profits that we've gained. But there are other avenues. I mean, Ted, you and I have talked about earlier in the week ways to hedge your portfolio. So ways to offset market declines without necessarily having to go in and raise cash by selling your underlying positions. Maybe you can talk a little bit about some of the opportunities you see there to hedge portfolios against this market volatility.
Yeah, absolutely. But the one thing I want to point out, you mentioned, addressing risk by selling. Selling a stock in a circumstance like this is not addressing risk, it's realizing risk. When you sell a stock when it's down because of something like this, you've accepted, you've convinced yourself that the risk is too great that the stock's not going to turn back around again. Again, as I said earlier, you got to approach that on a case-by-case basis. A lot of the stocks, for example, that we hold in our portfolios, Bauman Letter, Alpha Stock Alert, these are companies with good opportunities. I mean, they're addressing markets like 5G. They're addressing all these great new opportunities. Those are not going to go away. So selling those stocks now mean you're realizing a risk. You're actually taking the step to say, there was a risk and now it's going to cost me. But remember, you don't have to take that step. There are other things you can do, as you point out. One is you can put some of your money in fixed income. I'm looking at a chart now that shows the a 20-year Treasury bond ETF. It's up about 2% over the last 2 days. That's one thing you can do. They don't have a lot more room to run because yields are already very low, but at least that can prevent you from suffering any more losses. So that's one option. The other one, I think, is to look at inverse ETFs. And you and I have had some, extended discussions about pros and cons, but basically an inverse ETF moves in the opposite direction of whatever index it's tracking. So SPY, for example, is the S&P 500 main ETF. SH is its inverse. SPI goes up by 2%, SH goes down by 2%. And the opposite is also true. SPY goes down by 2, SH goes up by 2. So seems like a no-brainer, right? Well, the thing about these inverse ETFs, and I do think they play a role, is that you really have to watch them very carefully. I know a lot of people in the past have, basically tried these things and they're scared of them. But I think in this kind of environment, they can play a role. You buy an ETF that moves in the opposite direction of the market, but what you got to do is keep an eye on it. And my recommendation would be that you set limit orders so that when you buy a position like this, you immediately enter a sell order. And the way I would look at it is that I look at the average variation of that inverse ETF, let's say over the last 5 days, how much it moved during the course of the trading day. Let's say it's around 3%. So I would set a limit order that says sell if the price drops below 3% below my buy price. That way you're guaranteed not to lose money if the market turns around. Then you also get inverse ETFs that are leveraged, which can give you 3 times what the market goes down. S&P goes down by 5%. the leveraged ETF goes up by 15%. Seems like a great idea, but again, you've got to put in that limit order, and or you've got to keep an eye on that thing and sell it as soon as it turns, because you can also lose money. But again, that's a way to make some money out of the market if you're so inclined.
Yeah, I think the other thing to mention too with those inverse ETFs, whether they're leveraged or not, is the importance of looking at that as a short-term hedge for your portfolio, because the way that those things are constructed and rebalanced to maintain their inverse ratios, they can actually deviate from that inverse performance over longer stretches of time. I don't think it's something that investors should look to hold in their portfolio, certainly for any extended period of time.
Now, you're absolutely right about that. And, yes, of course, there is, the rebalancing effect's kind of too complicated to go in here. But the main thing is that the inverse ETFs are something that you might play over the course of 24 or 48 hours. In a way, it's almost a day trading strategy, but it can work for you very well, but it's not something you ever want to buy and hold. And in fact, some of the big brokerages have said in the past that they don't want retirees, for example, buying inverse ETFs in their retirement accounts, because sometimes they forget they have them and boom, they can lose a lot of money. So yes, I think inverse ETFs are something to use. I know some of our colleagues have recommended them. We recommended them on occasion in the past, but I would just be careful with them. I think the main thing is, it really depends on what you want to try to get out of this circumstance. I think the fixed income option, buying into bond ETFs or even just buying bonds directly, is a good bet right now. Yields are going to be low, so it's really about capital preservation. But the main thing is, if that's what you want to do, you want to preserve capital to be available to you when the market starts going back up again. That's what I do. If you want to play this dip, then I think the inverse is the way to go.
I'll go back to your bond comment for just a second, though, because not all bonds are necessarily created equal, and we know 10-year Treasury yields. I saw hit a record low this morning of somewhere around 1.16%, which is just absolutely crazy to think about. But there's more out there than just treasuries. There's different credit qualities, different levels of investment grade. It's just not one bond market that you can buy into, right? I mean, you have to be careful about what type of credit quality you're putting into your portfolio.
Absolutely, and I'm glad you pointed that out. I think that one thing I would stay away from absolutely is high yield corporate bonds right now. High yield corporate bonds, the ETFs that deal in those are basically companies that have dodgy finances. They've been able to borrow under the conditions of the last couple of years because there's so much money out there. A lot of these companies have borrowed money without really any recourse for the lender, which is highly unusual. They pay a lot. Some of them pay 4 or 5% yields, but they're highly risky. If the economy does take a downturn, some of those companies are going to default, and that's going to hit you as the bondholder. So I'm really talking about treasuries and potential other sovereign bonds, Euro bonds and things like that, and high quality corporate bonds. I think companies like the big players in the Dow. I mean, the companies that have plenty of cash flow are in no debt position to worry about. Sure, you can buy those. Just don't buy the junk bonds. That'd be the worst thing to do right now.
That's good advice and a good recommendation. Now, I think you used the term earlier of safe havens, and we tend to think about, especially in the fixed income space, treasuries as being a safe haven asset. What other safe havens, and when that term comes up, a lot of times it's because it's uncorrelated or it moves in the opposite direction of stocks, and that's what we've seen. As the S&P's decline, we've seen treasuries rally. But there's been other safe haven plays that have worked out well in terms of offsetting the declines in the markets that we've had. Are there any other safe haven assets out there that you're keeping track of right now?
Well, yeah, in addition to fixed income instruments like bonds and bond ETFs, I think buying gold, you can buy gold ETFs is probably a perfect strategy right now. Gold is at long-term highs and looks set to go higher. It's probably going to break the $1,700 barrier and leg up from there. So a gold ETF like GLD is probably a good one right now. Another option is currencies. Everybody likes the Japanese yen in a crisis. And there's funny reasons for that. Even if the Japanese economy itself is not doing strong, It has to do with the behavior of Japanese retail investors and all kinds of reasons why everybody likes the yen in a crisis. So that's another one I'd look at. There's been some pretty good movement. I'm looking at FXY, which is the Japanese yen ETF. It's up about 1.5% over the last 48 hours. So that just shows you, and that's up actually higher than gold. So those are a couple of options. I mean, strong currencies, the Swiss franc is another one. But I think there are many options for safe havens. So in addition to bonds, there are a number of other kinds of safe havens that you can buy. Gold is an obvious one. There are a number of ETFs that track the gold price. Gold looks like it's set to maintain a breakout above $1,700 an ounce, in which case it'll probably leg up fairly quickly. So GLD or GLDM, which is a fractional share, those would be good ones to look at. Then currencies. The Japanese yen, for example, is one that everybody loves in a crisis. And what's weird about it is it doesn't have anything to do with the Japanese economy. It's about how Japanese retail investors behave during a crisis, which tends to pump up the value of the yen. And right now, I'm looking at it. It's up actually almost 1.75% over the last 24 hours. That's the Japanese yen ETFs. The Swiss franc is another one. So there are other things you can do. You can buy any kind of a stock, or rather ETF, that it possesses or is focused on a safe haven asset, like strong currencies, like gold, like silver, for example. There are others. But the whole point of a safe haven, like fixed income, is to preserve capital and get you some kind of a small gain in a period of loss like we're in right now.
So the period of loss that we're in right now, I know it's easy to say, but very difficult to do, is to just stay disciplined, stay true to your strategy. And if you feel so compelled to have to step in and incorporate some sort of a hedge to help offset the decline, we've certainly discussed and shared a couple of ideas that our viewers can go research further, look into further from here. So this has been Clint Lee and Ted Bauman with this edition of Your Money Matters. Thanks for joining us today.